At 3 a.m. Eastern Time, before most American traders had finished their coffee, a sell-off that started in Seoul had already decided today's Nasdaq open. Micron is down 9%, Nasdaq futures are off 3%, and every major chip name on the planet is bleeding in unison. The question is not whether this hurts. It clearly does. The question is whether this is a temporary repricing, or the first visible crack in the AI hardware thesis that has driven semiconductor valuations to generational highs. That answer matters enormously for how you think about the next 12 months. Let us start in South Korea, because that is where this story actually began. Samsung and SK Hynix, two of the three largest memory chip producers on Earth, were routed on the KOSPI before the U.S. session opened. Micron, the only major American player in the high-bandwidth memory market, followed predictably, dropping 9%. When all three legs of a global oligopoly sell off simultaneously, that is not sentiment. That is a demand signal. Here's the framework you need to understand this. Memory chips, specifically DRAM and high-bandwidth memory, are the foundation layer of AI inference and training workloads. The hyperscalers, your Microsofts, Amazons, Googles, consume enormous quantities of HBM to run their data centers. When chip stocks representing the bulk of global memory production drop this sharply in unison. Across multiple exchanges, the market is pricing in one of two scenarios. Either near-term demand is softening, or supply is coming online faster than expected, compressing margins. Both of those matter for investors holding AI infrastructure names. Now, this is analysis, not fact presented to you as settled, but the pattern is consistent with a memory cycle that tends to overshoot in both directions. The semiconductor industry is famous for this. Producers expand capacity aggressively during demand booms, then get hit simultaneously when the cycle turns. The AI-driven demand boom of the last 2 years may have pulled forward significant capital expenditure, meaning the next phase could be a digestion period rather than continued acceleration. The actionable read here: if you hold broad semiconductor ETFs or individual memory names, today is not the day to react emotionally. It is the day to understand what the cycle position actually is, and whether your thesis was built on the peak or the trend. While the chip sell-off grabbed the headline, a second story deserves serious attention. Alphabet stock is set to fall for a second consecutive day, and part of the pressure is being attributed to a notable departure. Google's DeepMind has lost a Nobel Prize winner to Anthropic. That sentence contains more information than most people will process at face value, so let us unpack it carefully. First, the obvious. When a researcher of that caliber moves from one lab to another, it is not a personnel decision. It is a signal about where the serious scientific work is perceived to be happening. Nobel laureates do not chase higher salaries in the conventional sense. They chase problems and environments where they believe they can produce meaningful work. If DeepMind is losing that kind of talent to Anthropic, the market is right to take notice. Second, the broader context. Google's online dominance is already showing signs of cracking in the AI era. That is not editorial language. That is a theme several serious analysts and publications have been tracking through 2026. AI native search behavior is fragmenting attention away from the traditional Google query and click model. Alphabet is both a potential winner and a potential loser in this transition, depending on execution. Losing a research anchor to a competitor that is specifically focused on foundational AI safety and capability is not a trivial event. For investors, Alphabet presents a genuine analytical tension. It has the compute infrastructure, the data moats, and the capital to compete. But culture and talent are the actual production function of AI research, and those cannot be bought at the quarterly earnings call. The DeepMind departure is a data point, not a verdict, but it is the kind of data point that compounds quietly until it cannot be ignored. Watch talent flow as a leading indicator. It tends to precede product outcomes by 12 to 18 months. Oracle shed 21,000 roles over the past year. Sit with that number for a moment. Oracle is not a company that was supposed to be in the AI casualty column. It has been actively repositioning itself as an AI infrastructure and cloud beneficiary, winning data center contracts and expanding its footprint. And yet, 21,000 people are out the door over 12 months, placing it squarely in the wave of AI-era tech layoffs from companies that are simultaneously spending aggressively on AI build-out. This is the uncomfortable arithmetic that most AI coverage avoids. The narrative says, AI creates jobs. The reality, at least in the near term inside large technology organizations, is more complex. What appears to be happening is a structural substitution. Headcount in certain operational, support, and even mid-level technical roles is being reduced, while capital expenditure toward AI tooling and infrastructure increases. The ratio of human labor to output is being forcibly repriced across enterprise technology, and the workers bearing the cost of that transition are not the ones being celebrated in the productivity statistics. From an investment standpoint, this bifurcation is meaningful. Companies that can demonstrate genuine margin expansion through AI-driven efficiency, not just layoffs followed by rehiring under different titles, are the ones where the thesis holds structurally. Oracle's case is worth watching closely, because if a cloud and AI-positioned company is still cutting 21,000 roles, while investing heavily in AI infrastructure, one of two things is true. Either the AI investment is not yet producing the efficiency it promised, or the company is in a deeper restructuring than the AI narrative lets on. Neither of those is automatically bearish for Oracle long-term. But they are questions that belong in your due diligence, not footnotes you skip past. Remember, this is analysis and education, not financial advice. The point is to think clearly, not to react to a number. We opened with a question. Is today's chip sell-off temporary repricing or the first visible crack in the AI hardware thesis? The honest answer, based on what the data shows right now, is that it could be both simultaneously, and distinguishing between the two is exactly the analytical edge that determines returns. The deeper question this session raises, if memory chips, AI talent, and enterprise headcount are all being repriced at once, what does that tell us about AI's actual earnings cycle? That is what we are covering next. Subscribe so you do not miss it.